reasonably well, even though it's come off its record highs.
Yeah, and Gemma, just listening to what Sylvia says, this sort of strikes home why this bank recapitalisation plan is going to be so important, what, specifically how they do it. Because if they set a new Tier 1 capital ratio and then allow banks to hit it by reducing their balance sheets, we're going to, whatever growth we're going to have is going to have the life squeezed out of it, because we'll have another sort of credit recession, won't we?
Yes, exactly. Austerity doesn't foster growth, and that's the balancing act that they're trying to get, and that's why in the UK we're actually risking stagflation, and in Europe that's potentially why they didn't cut rates. I mean, there is this risk of, you know, how do you boost growth, but also how do you rein in bank lending, which is obviously going to affect the growth outlook and lending and consumer confidence, etc.
So within this difficult balancing act, on the one hand, we can't squeeze growth completely with austerity, austerity, austerity. On the other hand, we have to come off these budget deficits. Do we have to, in inverted commas, risk a recession to, after that, be able to grow ourselves out of it again?
Well, it's a tough quandary, and actually Europe's in a lose-lose situation, because if you look at it on the one hand, you know, how are they going to be able to actually recapitalise the banks? You know, are they going to use the firepower? They're going to increase the firepower of the rescue fund by potentially leveraging off of that. That increases risk. That potentially leads to a downgrade, as we're seeing in France, of their credit rating. Or are they going to nationalise, as Belgium did? But then again, that risks downgrading Belgium's you know, credit rating. So you've got this very, very tough quandary, and obviously countries are very protective of their AAA rating, and we're seeing that in the UK, when actually the country has stepped back from being able to bail out the banks, then actually the banks themselves then get downgraded. So whatever happens, you know, it's going to be negative either for banks, for the country, for growth.
Okay, Sylvia, we'll let you go. Thanks for that. George, how are you factoring in? You know, everybody says the Eurozone crisis is the thing that matters most to the rest of the world. I mean, what are you supposed to do with this when we really don't know where we're going to end up, and we don't really know how we're travelling to whatever that end conclusion may be either? What are you supposed to do as an investor?
Well, in the U.S., I think the investors have to look at our current debt in America, and the only way out of this is inflation. And if anybody you know, thinks differently, they're not paying attention to the numbers. I think America is going to have to do what Brazil did, which is have a short period of increased inflation, and then try to put a quick end to it. And so when you're looking at that kind of environment, you have to stay close to the commodities here in the U.S. And there's no question about it. Europe's risk is definitely, we have, I think, in America, more exposure than we realize, than as a country, and the banks and the lenders, and then finally the investors have more exposure to what's going on in Europe than, but we're going to see that play out. But from an American perspective, inflation is coming, and you stay next to the commodities.
But isn't that a dangerous way to do it, though, to inflate yourself out of this? Because what if you can't control it on the back end, and also doesn't that create tensions maybe with other countries that you deal with on a daily basis? It
is going to create, it will create problems with other countries, but America has gotten to a point where we are spending too much money. Our government is spending too much money. You take 1961 under Kennedy, adjusted for inflation, we were spending $700 billion as a government. Today, we're spending $3.7 trillion.
Well, why not spend less, reduce capacity, and have a couple of stretches of slow growth, and then once you get there, you spring load to grow? I mean, you got some foreign policy issues if you really inflate your way out of this.
Even if you do that, you still can't take care of 70+ trillion of debt.
Interesting.
It's too big of a number.
We'll pick up more of that conversation just a little bit. George Jarkisy of Jarkisy & Company, of course, Gemma Godfrey of Credo Capital with us in the UK. Coming up next on Worldwide Exchange, we have inflation. We just talked about it. Fitch and Ben Bernanke.